Everyone, we'll probably just wait for a minute or two for everybody to get into the session and we can get started right after. All right, it's 1 p.m., so let's get started. Hi, everyone. Good afternoon. My name is Anu. I hope you can hear me, and I'm a part of the customer success team here at Snap Projections. Along with me, I'll be joined very soon with Lee Martinson, who's our very own customer success manager here. Welcome to our product walkthrough and Q&A session today. The main agenda for our sessions like these is to offer our clients an opportunity to ask us any questions. So feel free to ask us any questions. We also use the sessions or sessions like these to give a refresher on some of Snap's functionalities. And if you're somebody new, then hopefully you'll get to learn something new today. Today, my plan is to review a client whom I met back in 2019. Of course, I'm using a hypothetical use case here. And my aim for this client is to assess whether they are still aligned with their projections we initially created for them, or if there are certain adjustments needed considering that it's an older plan. So if you do want to ask us any questions, I could quickly show you. You could go into this question mark area and ask any questions to us. I'll be happy to pause in between and address any of those as well. So I'm going to quickly switch into our Snap account. So whenever you get into Snap, you will be looking at an interface like this with a list of clients. So our clients today are Sam and Sarah Prince. So when we get into this plan, instead of seeing our usual run scenario button, what you would come across is this rebase button. And you'll also notice that we are not able to edit any values into the plan either. So on the top right hand side, you'll notice this rebase button. Now this button will allow us to update our original projection to the current year financial data in 2024. Here, the rebasing button will not replace or delete the original scenario, but it will in fact create a new projection based on the most recent financial values. Now, what I'm going to do is quickly review on what is happening with Sam and Sarah's projection that was created back in 2019. Now, for their case, we had incomes, and something that was different is beside their employment income, they had two separate columns. One was for inheritance that this client was supposed to receive in 2026 for 150,000. Also, their plan was to do renovations back in 2021 as well. Now, as I discussed this plan with them and the status of these two updates, they mentioned that they did in fact complete the renovation and it costed them slightly more than expected. However, luckily, they already received the inheritance sooner, and that covered for any extra cost, and also any leftover was then contributed into their capital assets. Now, along with this, you would notice that for Sam, or and even for Sarah as well, they are doing certain contributions into their RSPs and TFSAs, which they did let me know that they did continue to do, and their plan is to continue to do so even until they retire. Awesome. So now before I click rebase here, what I'm going to do is I'm going to go ahead and download a report of this 2019 plan. So then it will allow me to compare the 2019 projected values to a most recent plan that we'll update for 2024 with these clients. So I'm going to go under client report and I'm going to simply do a download PDF button. And that for me will create a copy of this report that was done back in 2019. Okay, now I'm gonna go back here under our planning pages and I'll click onto the rebase button and that will allow me to update the original projection to the current year. And also when I click onto the rebase button, it will complete the process for me. And here we will see that our current year starting is shown in 2024. So I'm gonna go ahead and rename this as well and call it projection or just 2024 plan, just to keep it simple. Okay, now if you're wondering what really happens when you rebase it, so there are two things happening. One, that we discussed, the start year moves to now 2024. Secondly, the projected values of the 2024, the projected values in our 2019 plan are now the initial values in the 2024 plan. So you will see that any values that we could see in our 2019 plan of the 2024 projected year, I want to go under cash flow and all of these things, the net worth projection, they are now the initial values of our 2024 financial year plan. Okay, so now with this rebase projection being in place, we will review each and every input considering any necessary revisions based on the updated numbers. We also introduced an additional page called expenses. So I'm going to go over that as well in as we get onto this page. We'll also evaluate at this point whether the clients are still on track with their goals, which is our main agenda here. And along with that, when I had a discussion with these clients, they talked about two new changes that they're planning for their projection. One is they plan to give money to their children at the age of 75 of Sam, and secondly, they are planning to go on vacations from now until they are age 74 every second year. So we'll go ahead and also explore on how this will impact their projection and also on how to input some of these numbers. Okay, so for now, we'll get into the 2024 plan and let's start from the very beginning, the scenario setup and the client button. And let's take a look at some of these numbers and see what all we need to update as we go into each of these sections. So when we start from the client page, there are no changes on their date of birth. They're still in the province of Ontario, so that looks good. Let's go on to the next page, which is the general page. Now, here we will see that our inflation rates, the indexing of CPP, QPP, and OS is sitting at 2%, and the rates of returns that were applied earlier, 1%, 2.5, and 6%. Now, I can either go ahead and click on use guidelines that will change these values as per the projection assumption guidelines of FP Canada, or I could continue to stay with these rates of returns and the inflation rates. So what I'm going to do is I'm going to first click onto the use guidelines to take a look at what the updated rates are. Here, our general inflation is 2.1, the indexing for CPP and OAS is 2.1. However, I want to go back to these rates of returns. So I think it was 1%, 3%, and 5%. So these will not really impact our existing asset accounts, but for any of the new accounts that I create going forward into the projection. I can also go ahead and click defaults for any new scenarios to have these inflation rates and rates of returns as well for me. Okay. Now what I'm going to do is when I'm happy with the general page, the in retirement is still happening at 65 for Sam, 64 for Sarah. We're continuing the plan until age 100 and their projection is starting from 2024 until they reach age 100 respectively. Let's go on to the next page. Now, this is a new page for us for the expenses page that was not in the 2019 plan. For this case, as we progressed our discussion with Sam and Sarah, they did mention that they want to spend about 65,000 in retirement in their base expense, or what you could also explain or describe as lifestyle expenses after taxes in retirement. So here, I'm going to change this value to 65,000. And additionally, as you might remember, we talked to them regarding their plan, and they have two additional expenses in their mind moving forward in with this plan. First, they want to put an expense for gift to children, which is about $150,000 at Sam's age of 75, which is the value that their kids would need for their home down payment, and they want to help them out. So, and the other is, of course, the vacation expense that they want to do every second year from now until the age of 74. So we're going to click under additional expenses and add expense to create these two additional expenses. So I'm going to go ahead and say gift to children, and I want to keep reminding if there are any questions in your mind, like you could go ahead and type it in and I'll be happy to address them. So I've put in the description the amount. We're going to say that it is a jointly owned expense. We will be tracking this with general inflation, which is 2.1%. If it would be any different inflation percentage we want to track it at, I could have added it, but I'm going to simply go put enter delete and it will stay at general inflation. Now, from age and to age, in this case, because this expense is only happening in 1 year, I'm going to set up the same from age and to age. Just quick reminder, we don't want to change these prorating years or be more specific with it. Otherwise, this value will be prorated only for those number of days. So, however, we want this full value to be tracked as an expense. Now, the frequency section is really not relevant at this point because it's just a 1 year expense. And we will go ahead and highlight this expense as a separate legend in our cash outflows charts. Then I'm going to go ahead and add another expense. And if you remember, this is our vacation expense, which is, so I'm going to do vacations or just vacations, fine. Now, they intend to spend about $10,000 and it will be jointly expensed out. So 50% between Sam and Sarah. We're going to track it at general inflation. Now they mention it's from now until they reach age 74. So I could leave the from age as blank. Snap will assume that it's happening from now. And the to age will stop this at 74. Again, we're tracking everything as per Sam's age here. I'm going to put the frequency as every 2 years and we will go ahead and highlight this expense. Okay, so now with these two, we'll also go on to the planning pages to see how these look as separate columns and how they impact our plan. So we're definitely gonna do that. Now, if you remember from the previous plan, we had two sections, one under income, one was renovation cost and other was a positive income of inheritance that Sam was receiving. So for the renovation cost, if that expense would still exist, then we would go ahead and add it under the additional expenses. So this is the new place where we want to add in any expenses for this client. Now, of course, because that expense has already been done, we don't have to really worry so much on it. Now we go on to the next page, which is our income page. Now here we'll be reviewing incomes for Sam and Sarah. So I'm going to be first looking at Sam's page. And you would see there's employment income. There's no change here. However, in this, with the new changes that we've done in SNAP, we can also index this income as a general inflation. It is employment, it is taxable RSP eligible, and it ends at age 64. I can, however, be more specific on the end of this employment income. For now, I'm just going to leave it so. Now, these two columns that we had in our 2019 plan are not relevant anymore because these two events have already taken place. I'm going to delete these. Now, for Sam, he doesn't have any employment, any pensions. However, as I jump under Sarah's tab, she does have a pension as well. So let's fine tune some of these information points here. The description is employment income for Sarah. The amount is still the same. However, now we want to track it at general inflation. It is employment, it is taxable, it is RSP eligible, and it ends at her age 63 because she's retiring at 64. The next thing we want to do is look at the pension. So start age 65. So we want to focus on age 65 and after, the amount, the survivor percentage, and indexing. However, I want to change this to 2.1 to track it same as our general inflation. And we will prorate this pension to have it started as per her date of birth and prorate to that value. Now, whenever we make any changes here, this button says edited. So if I click away, it will save my information. So if you click away, that just makes it a little bit easier to ensure that our information is up to date in our plan. The next thing we are looking at is assets under Sam and Sarah. So if you remember, I'm going to go under Sam first. If you remember, we talked to them and they mentioned that they received the inheritance and they in fact have contributed any additional money under their capital assets. So the values are now up to date. So I'm going to go ahead and update this. So Sam now has 120,000 in RSP. He got an opportunity to max out his TFSA, and the non-registered also has about $10,000 and about the same amount right here. Also, because now they're very close to their retirement, they do want to change their asset mix to more into a balanced fund. So we are going to change this into fixed income 40% and equity 60, just to change their portfolio to a more balanced profile. Sorry about that. Let's do that right here. And 40, I'm going to make this as 0% and 60. I'm going to quickly do the same changes for Sarah as well. For the real asset as well for Sam and Sarah, both the value is still the same. However, let's appreciate this at 2.1%. It is jointly owned and non-capital gains tax. So I'm going to go under Sarah, update the values for her assets. This is sitting at about 120,000. The TFSA did get maximized to 90,000, and we have about 5,000 sitting into her non-registered. And let's quickly change the asset mix to a more balanced profile in their case. And I'm doing this for all the three accounts for them. Okay, so now with that being done, we have the updated information, the real assets. I just want to quickly remind everybody now with some of these updates done in Snap, we have the FHSA account option as well. So if these clients would not have an FHSA, or they haven't had a property yet, or they were intending to do their first time home buying, we could also create an FHSA account giving out all the details of what they can contribute into it, and Snap would track those values for them. Now, moving on to the next page, we have debts here. So for mortgage, they did let us know that there was a mortgage renewal that happened. So things are looking different. However, the balance is the same. The interest rate has changed to 5.5%, and there's no, of course, it's still interest and principal, and their monthly payment is about $1,000, which is jointly owned, and it is linked to the house as a real asset. Now, doing so makes it very advantageous for us, because in case they want to sell their house, Snap will take care of the balance by paying off the money towards the mortgage first and using the proceeds from the house sale as a part of their as a part of their investments afterwards. Okay, so now with that being done, we're going to look at the government benefits. So in case of government benefits and when we rebase a plan, there are two situations that could happen. So in first case, which is the case for Sam and Sarah, if they haven't yet started to receive their government benefits, what Snap will do is it will take the original percentage of maximum, in this case it's right here, and it will in the rebase version, it will apply this percentage of maximum to the new CPP QPP maximum value for the individual and calculate the annual pension retirement amount. And it will do the same thing for OAS as well. Now, second scenario is if your client has already started to receive government benefits, then Snap will use the original value that was entered in CPP or QPP annual retirement pension and index it based on the indexing percentage, and the percentage of maximum remains unchanged. Okay, so in this case, we're going to be going with the values that Snap created for us. However, I'm going to prorate the first year for this plan just to make sure it's being tracked as per the date of birth of the client, and it will give us the prorated values. Now, with that being done, in this case, our client does not have any insurance, any education, or any corporate plan to look at. So we'll go ahead and go under the planning pages, and we'll go under the combined planning pages to look at some of these numbers. So first thing that we want to see is go under the very bottom of the plan to see if there are any shortfalls, which could be identified as these negative values in the plan. And let's also take a look at the two expenses. So we do see there are shortfalls happening at age 90 and 89. So clearly this does not seem to work for this client, the plan. um, and we're going to go ahead and revisit it. And then here you'll see that we have this gift to children and these vacation expenses happening into the client's projection. You will be able to see these employment incomes, these pension values, and the CPP and the OS also tracking. And I want to go ahead and take a look at the capital assets. The client is still doing these contributions into their accounts, and they have this real asset that's tracked as well. So I know it's quite a different change because now they have a shortfall in the projection. But now let's go ahead and compare our plan with our 2019 projection to see what is exactly happening in their 2019 projection. So what we do want to compare is under our client report for 2024, I want to look at the net worth statement to see what is the current net worth for this client for now and compare it with the net worth projection of the 2023 year end value. So here the client's net worth is about 623,000 versus in this plan we have about 819,000 in the net worth. And obviously the money is higher because of the values that are sitting in the capital asset at this point. Because the client received the inheritance, they have about 440,000 into their inheritance versus in this case, if you would look at their all types total capital asset, it was only 243,000. So amount was definitely lower. And here they are doing much better in terms of their net worth for this year. However, I want to bring a few things in perspective when we are reviewing such plans and looking at the previous year's plans to the current year, that there could be several factors that impact such a change in the projection, especially when we are looking at previous projections to the current projections. Now, of course, if the numbers are looking good, or if they're not looking that great, there are certain controllable factors and certain uncontrollable factors per se that could impact it. Now, controllable factors could be things like income adjustments, expense increasing or increased savings, and they all play a favorable role, or sorry, decreasing of expenses and increasing of savings, and they all, of course, play a more favorable financial plan situation. However, on the other hand, you will notice that there could be some uncontrollable factors, including things like economical conditions, and we are looking at interest rates changing, inflation rates changing, or unexpected events happening in the client's plan, things like health or some uncalled for expenses that they were not planned for, and these all present changes that we have limited control over. So keeping those things in mind, in these cases the plan, of course, in terms of net worth seems to be doing better for this year. However, moving forward and as more changes that they expect, things like vacations and gift to children, they do eventually run into a shortfall that we want to revisit at this point. So what we want to do when we're reviewing old plans is we want to try and understand what these changes are and how they are impacting a specific client plan. Now, for this projection, at this point, we want to go back onto the planning pages, and I want to go under the recommendations button to see how we could improve this underfunded status for this client. They're underfunded slightly. It's about 300,000 of overall underfunded status. And what we could do is run some of these calculators right here to revisit on what could be a better situation for this client. Now, if you remember, this client told us they want to spend 65,000 annually post-retirement. However, obviously that number gets them into a shortfall and doesn't seem to work for them. So what I could do is I could run a sustainable spending calculator to show them what is the maximum sustainable amount that they can spend each year and not run into a shortfall after when they retire. So I'm going to hit calculate. It takes a few seconds to do this, and it gives us an answer that's 62,720 each year, or about $2,200 less each year would not put them in a shortfall, and their projection will do great. So I'm going to go ahead and apply and run this. But before I do that, I'm going to say copy scenario before applying recommendations, and then apply and run this to create a what if plan for this client. So now here it says 2024 sustainable spending, the amount is 62,000. And with that adjustment, this client is still able to do the gift to children column, and have that expense being adjusted to inflation, which still works for them. They are also able to do the vacation that they plan for. Now, last thing before we end this is we want to go under our charts page to take a look at how those additional expenses look. So here is our base expense. Then you remember we have this gift to children expense under our legends as I hover over it. And we have this vacation expense also show up under the cash outflows charts. There are other outflows of income that are happening, like income tax, debt payments initially, capital asset contributions that they are doing, and it aligns with our total inflow, letting us know that there is no shortfall. You can also look at other charts with your clients, like their cash inflows chart. So where all are these income of money coming in from, and what are all these sources. So initially there's employment income, later on there's pension, OAS and CPP, then there's RSP and TFSA, followed by just a little bit of withdrawal, or actually the income out of the non-registered. We do have other charts like net worth or asset allocation that you can discuss in details with your clients. And this is also a part of the client report that we have right here. Awesome. So now with that, I'm hoping that this whole rebase projection situation is helpful. You might see this coming more often as you create more plans for your clients year after year, and review these numbers with them. Now I'm going to open for any questions and see if there are any questions that you guys might have. And yeah, let's see if some questions come up. I know there are few people that have joined us today, so just checking in if there are any questions. Okay, so if there aren't any, what I'm gonna do is I'm gonna quickly show you guys how you could reach out to us for any questions that might come up in future, or be more specific to the plan that you're working on. So whenever you are in Snap anywhere, here on the top right, you're going to find this help button. You could click under help center, and at the very top, you have our support line number, or you could press contact and drop us an email. Alternatively, similar to how we did this webinar, there is a whole section of webinar specific to the topics, each of these different ones, some tackling specific functionalities like life insurance, recommendations, stress testing, RESPs. There are, corporate plans. So you could look at some of these projections and webinars, and work on these along the way. Also, if you have any questions that's more specific, things like, let's say, GIS. So you do have a way that these articles that show you how to create some of these specific accounts and specific income types in the plan, and you could review these, and also follow some of these screenshots to create this account in your own plans as well. Awesome. So now with that, I'm gonna close the session. And if you do have any questions, like I said, reach out to us from the top, or press contact and let us know what your question is. We'll be happy to help you. Awesome. Thank you so much, everybody. I hope the session was helpful. Again, if there's anything that comes up, don't hesitate to reach out to us. Thank you so much and have a wonderful day. Take care.